Are we in a stock market bubble? I get this question multiple times per week, and with people like Sam Altman, the founder of OpenAI, coming out and declaring an AI bubble, while the S&P 500 keeps reaching record highs, valuations are continuing to be stretched, and tech names that just feel unstoppable. And then on the other side, you hear whispers of a possible recession, or a debt crisis, or inflation coming back. So what do you do as an investor? Do you cash out? Do you protect? Do you just ignore the noise? Well, today we're going to do two things. First, we'll walk through the classic signs of a bubble and see how they're showing up in today's market. And then second, I'll lay out the menu of options every investor has when they suspect a bubble is forming. And you might be surprised about which one makes most sense for you. Now, before we dive in, let me ask you, if you thought we were in a bubble today, what would you do? Or what are you planning to do? Are you planning on selling, hedging, just riding it out? Drop your answer in the comments below because I read every single one of them, and I'm really curious about what you would do if you thought we were in a bubble. Now, if you're new here, I'm Jonathan Rankin, the founder of Theorem Wealth, and I've been helping people retire with confidence since the housing bubble popped. But how do you even spot a bubble? Because a bubble isn't just stocks are high. Bubbles happen when asset prices get disconnected from reality, when people buy because they think it'll go up, not because of fundamentals. And one of my favorite research analysts, David Rosenberg, recently published a piece that laid out 7 indicators of a bubble and concluded that the current backdrop checks every box associated with classic bubble behavior. So let's go through the signs of a bubble. Now, the first sign is valuations, and they are stretched right now. Because when we look at long-term valuation measures like the Shiller-Cape ratio, the market's sitting around 38 times earnings, and that's a level that we've only seen a handful of times in 1929, 2000, and late 2021. Tech stocks are trading at 10 times sales, which is their highest in history, and even the median S&P 500 sector is close to record highs at about 3 times sales. That's not just expensive, it's historically rare. Now, the second sign is leverage, which has been piling up, because investors are using borrowed money at unprecedented levels. Right now, margin debt has topped $1 trillion for the first time, rising 25% in a year, while call option activity is also at record highs. See, that leverage, it acts as lighter fluid. It makes the rally hotter, but if prices turn, that fire burns a lot faster. Now, the third sign of a bubble is positioning, and right now, fund managers have their lowest cash cushions on record, which is roughly 1% of assets. That means there's almost no dry powder left to buy the dips. If the market wobbles, there's just no cushion. Now, the fourth sign is expectations, and right now they are euphoric, because household surveys show that the average investor fully expects stocks to be higher 12 months from now. Confidence readings are at bullish extremes, and that kind of optimism has historically been a late cycle signal. Now, the fifth sign of a bubble is sentiment, because investor surveys, sentiment indices, and measures like CNN's Fear and Greed Index all show optimism far above normal. Now, they're not at peak levels right now, but it is in this complacent zone where everybody assumes that good news is going to keep rolling in. Now, the sixth sign that we may be in a bubble is concentration, because right now, the top 10 stocks in the S&P 500 now make up 40% of the index, even more concentrated than at the 2000 dot-com peak. Nvidia and Microsoft alone account for 15% of the entire index, compared with the top 2 names being just 9% back in 2000. Now, the last sign of a bubble is over ownership, because households now hold over 70% of their financial assets in equities, and that's a level that preceded the 2001, 2008, and 2020 bear markets. So are we in a bubble? Well, maybe not at dot-com levels, but the ingredients, high valuations, speculative behavior, and debt-fueled risk-taking are absolutely in the mix. Now, does all of this mean that the market's going to crash tomorrow? No, not necessarily. Bubbles can last a very long time, but history tells us that when all 7 of these signs are flashing, risk is higher, fragility increases, and what you do next as an investor matters more. And that's why this is the exact time to stress test your own portfolio. And if you want my team to help you do that, there's a link in the description below where you can reach out directly. We'll walk through what these bubble signals mean for you, your retirement plan, and how to protect your wealth if things turn fast. So if all the signs of a bubble are flashing, what can you actually do about it? Well, there are a handful of approaches, and each one comes with their own trade-offs, and one of them is just a horrible idea in general. But let's walk through them, and then I'll share my thoughts on which option you should choose. Now, the first option, by far the worst option, is you could sell everything. This is the classic I'm out move. The idea is to take all of your chips off the table before the house of cards comes down. And sure, that can feel like a smart play if you're convinced the crash is around the corner. But here's the challenge. See, bubbles don't pop on your schedule. If you sold your tech stocks in 1997 because they looked expensive, you would have missed another 100% run-up before the bubble finally burst in 2000. In other words, timing feels safe in theory, but it's brutal in practice. And there is also the other side of the equation, which is getting back in, because the market typically bottoms before the news does. So do you actually have the stomach to add more money to stocks when things sound bad? Now, another path is that you can hedge or protect. See, you don't have to abandon the market. You can insure against the downside. Think of it as paying for home insurance. You hope that your house never burns down, but if it does, you're covered. And in investing, that might mean strategies like buying put options or setting stop loss orders. For example, during 2022 sell-off, when the S&P dropped nearly 20%, hedges like puts softened the blow for those who had them in place. Now, of course, hedges aren't free. They do cost money, and over time, that cost does add up, but they can provide peace of mind. Then there's rebalancing. And honestly, this one, it just doesn't get enough credit. See, rebalancing is like trimming the branches of a tree that's growing too wild. It keeps things healthy. If your stocks have exploded higher and now make up more of your portfolio than you ever intended, rebalance brings you back to balance. Now, the best part about rebalancing is that research actually shows that investors who rebalance regularly not only keep risk in check, but also often end up with higher returns over time because they're systematically selling high and buying low. Now, diversification is another tool you can use. This one's about broadening the base so your entire portfolio isn't tied to the same bubble risk. That might mean adding international stocks or bonds, commodities, or even alternatives. Take 2000, for example. The S&P 500 fell almost 50%, but areas like emerging markets and commodities held up much better. See, diversification doesn't prevent losses, but it does make the ride a lot smoother when one part of the market hits turbulence. Now, one option is, of course, you could do nothing, and that's a perfectly valid choice if it's intentional. Because maybe you're a long-term investor with a solid plan and you know that you can stomach the ups and downs. If that's you, then staying the course can actually work out. Because after all, investors who rode through 2008 or 2020 and they didn't panic, they were rewarded with strong recoveries. The key question here is, can you actually sit tight when the market is swinging? Because doing nothing only works if you can truly handle it. And then finally, there's the gradual adjustment route. This is for people who don't want to slam the brakes, but don't want to floor it either. So instead of selling everything or going all in, you might dollar cost average out of riskier positions, or slowly build up cash reserves, or rotate into more defensive sectors like healthcare or utilities. This middle ground avoids the extremes of panic selling or blind complacency. So how do you know which option is right for you? Well, it depends on two things. One, who you are as an investor, and secondly, how your portfolio is actually positioned right now. Because first, it does start with you, because everybody loves to talk strategy, but none of that matters if you don't understand your own tolerance for risk. Can you actually stomach a 30% drop without panicking? Or are you the type that loses sleep if your account dips 5%? You have to be honest with yourself, because the best strategy in the world doesn't work if you can't stick with it. And then secondly, you want to look at your portfolio under the lens of a bubble popping. How concentrated are you with the hot names? How much of your wealth is tied into one sector, one company, or even one country? Are you sitting on too much cash, or maybe not enough? See, stress testing your portfolio this way helps you see not just the potential upside, but also how fragile it might be if the market turns. And that's where I think the best approach comes in, and that's not extremes like selling everything or ignoring the noise, but a thoughtful middle ground. That means rebalancing to keep your risk aligned, diversifying so you're not dependent on a single bubble staying inflated, and making gradual adjustments instead of swinging wildly in or out of the market. Now, if you're not sure how to actually apply that to your own situation, that's exactly what I help people do every single day. So in the description, there's a link where you can reach out and schedule time with me or my team, and we'll walk through your numbers, test your portfolio against different bubble scenarios, and build a plan that matches your goals and your stomach for risk. At the end of the day, no one knows exactly when or how a bubble will burst, but what you can control is your preparation, your allocation, and your discipline. Because the investors who come out the strongest, they're not the ones who call the top, they're the ones who built a plan that they could actually live with when the music stopped. Now, here's the part that doesn't get talked about enough. See, for retirees, the real danger isn't just whether or not the market is in a bubble. It's the order of returns that you get once you start withdrawing money. See, two people with the exact same portfolio can end up with completely different retirements simply because one of them hit a bad sequence of returns early on. And that's why understanding and planning for sequence risk is just as important as spotting bubbles. So if you're approaching retirement or already living off your savings, make sure you stick around for the video coming up next where I break down sequence of return risk. We'll look at why it's the silent killer of retirement plans and most importantly, what you can do to protect yourself from it. I'll see you there.